And unlike a whole life or even a term policy, you can change your monthly premium with a UL policy anytime. And you may be asking yourself, well, how is this possible?
Like, subscribe, and share to Voices of London TV.
Hello, lovely folks. Welcome to another Monday Minute episode. I'm Ingrid B. Clayton. So I'm going to share that I have a bit of sniffles going on. So sometimes I may sound a little bit off, but I think I'm clear enough for you to understand what I'm going to be saying. So do bear with me. So in last episode, I talked about the benefits of a participating whole life policy. And in this episode, I'm going to be talking to you about the benefits of a universal life insurance policy. Now, I think I shared this with you before, but just in case, there are two permanent life insurance policies. There is the universal life insurance, and then there's the whole life insurance policy. And you should remember that last time I shared that there are two types of whole life insurance policies. There's the participating whole life, and then there's the non-participating whole life. Now, if you don't recall, it's time to go rewatch the last episode. So go ahead and pause this episode right now, watch, then come back. Okay, before I share the benefits of the universal life insurance policy, and sometimes I'll be saying UL, but when I say UL, I mean universal life. Okay. Now, let's touch on the key differences between the universal life and the whole life. Now, all universal life insurance policies automatically have two components. Now, there's the life insurance component and the investment component, and each is viewed separately. However, only the participating whole life policies have an investment like component where you can pay more premium to increase your cash value faster. And of course, any dividend that you receive, is usually tied to your investment portion for the whole life policy. And so your investment grows, your cash value, which is kind of your investment portion, that gets to grow faster with the dividend. The non-participating whole life policies, however, is usually your debt guarantee. There's no investment like component to that. If you compare the universal life and the participating whole life policies, you will see that the UL, the universal life one, has a guaranteed cash value from the first payment. This is because part of the premium automatically goes towards the cost of insurance, while the other part goes towards the investment portion. This is not the case with the this is not the case with the whole life. It takes some time for the whole life to accumulate some guaranteed cash value because it's just designed differently, right? You will also see that while UL policies give you a guaranteed rate of interest, there's no guarantee interest rate with the universal life. And since the insurance companies have to guarantee the interest rate for the whole life, they tend to give a more conservative interest rate on your cash value. And for this reason, the cash value in the whole life policy may grow at a slower rate than the cash value in the universal life policy. Now, here are some of the key benefits of a universal life insurance policy. With the UL policy, you can invest in funds where the rate of return is tied to the market. So there could be a greater potential for gains. However, as the interest rate is not guaranteed, there could also be a greater potential for loss too. So do keep that in mind. And like most things, while you may win some, then you may lose some. So where you get greater benefits sometimes you lose some of those benefits, right? That's just life. Now, a universal life policy is also more flexible than a whole life policy because the premium is not fixed, as is the case with the normal whole life policy. And unlike a whole life or even a term policy, you can change your monthly premium with a UL policy anytime. And you may be asking yourself, well, how is this possible? And this is possible because with a UL policy, there's normally a minimum and a maximum premium that you can pay. As usual, the government loves to restrict how much you can invest in any tax deferred investment, hence the cap. But the benefit of the maximum is the higher premium you pay, the more will go automatically towards your investment portion. But it's good that you can pay more one month than less the next month, which comes in very handy if you're facing some cash flow problems. And that could be perhaps because you're laid off, you're changing jobs, or some unexpected large expenses came up. So it's good that you really have that flexibility. You may even skip a few payments with the Universal Life as long as the cash value from the policy is enough to cover the monthly premium. This is so different, from a whole life or even a term insurance where you cannot skip premium payments. You have to keep paying. And for the universal life, you can also adjust your debt benefits so it fits well with any life changing circumstances. For instance, perhaps you used to be a caregiver, but that is not the case anymore. So you don't need to leave that large sum of money. And so you might want to adjust your debt benefit for that reason. And of course, with a UL policy, you can choose your own investment products. That is not the case with a whole life policy where the insurance companies will choose what they invest in, which if you think about it, it's really fair, because if they're going to guarantee the interest rate, it makes sense that they should choose what they deem will, provide a good rate of return for you. Because it's profit sharing, any return they get, they share it with you. So the more they get, the better. And that is why they can guarantee the interest rate if they can invest in something that really grows well. Now, because there is flexibility with the UL to choose your own investment products, you can actually invest in high risk funds. But as I shared above, doing this will cause your interest rate to be sensitive to market conditions. So you could see the interest rate on your investment portion adjusted higher or lower depending on the economy and the market swings that are going on. Some insurance companies will actually provide a minimum guarantee interest rate on the investment portion of the UL to incentivize their customers, and they can do this because most insurance companies have some confidence in the investment products that they provide for their customers to choose from. So they can indeed provide some guarantees while giving you the autonomy to choose your own investment products from their list. Because usually when you choose your investment product, it would have to be from the list that they have. It cannot be just any random investments that you're choosing. Also, with a UL policy, you can withdraw from the investment portion without affecting the debt benefit. But withdrawing from the cash value of your whole life usually affects the debt benefit. It's better to borrow from a whole life and repay the loan than to withdraw from the cash value, because that does affect your debt benefit. Now, having said all of that, personally, I don't think one insurance is necessarily better than the other. It all depends on your financial goals and what you're wanting to achieve. If you find that you're risk averse and you like guarantees and peace of mind, I say perhaps the UL is better for you. It's kind of like you said it and you forget it. You don't have to worry about it. So you have that peace of mind. Plus, there are some whole life policies that you can set up with, and then they call it an EDO, like an accelerated deposit option, where you can dump more money into it, but still you can't choose your own investment product. So you still have to go with the guarantee interest rate that the insurance company will give you. But still, it does give you a greater benefit for increasing your cash value faster. And if you want more flexibility and the potential for higher growth, then the universal life may be better, a better option for you. So it is important that you let your advisor know what you want to achieve. Is that benefit more important to you, or a larger cash value is more important? Plus, don't forget that you can always do your own due diligence and get some questions answered before making your final decision as to which insurance you will choose. And this is where I will leave you today. Until next time, do what good. Thank you for sticking with me.